Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Let's turn to the Federal Reserve. The Trump administration piling the pressure on Fed Chair Jay Powell.
The president said he is not going to fire Chair Powell. It would do Chair Powell a favor, and he would be doing the institution a favor if he did an internal review. This mission creep from the Fed is endangering their independence of monetary policy.
President Trump making a rare visit to the Federal Reserve this afternoon to see the $2.5 billion renovation. Ajay Rajadhyaksha of Barclays writing, concerns about Fed independence persist, but we expect status quo to prevail. Ajay joins us now for more. Ajay, good morning.
Good morning.
This market has shaken off a lot. Threats to Fed independence, trade, tariffs, threats, actual tariffs. Can this economy keep shaking it off?
Yeah. I think as long as you don't get a policy mistake out of Washington on the magnitude of actually trying to fire the Fed chair, which I don't think will happen, I think we are past the worst of it, and we are looking forward to a big boost in growth over the next few quarters.
So this is really important because some people still fear that the worst of the data is ahead of us. What gives you confidence?
The fact that there have been virtually no second-order effects. Now, remember, I agree with your previous guest. Libby made the point that there have been substantial tariffs. If you had told me we are at 2.5% entering the year, we finished at 17, 18, I would have been shaken. But part of the reason I would have been shaken is that because I would have expected business investment to pull back. I would have expected consumer precautionary savings to go up. Fact of the matter is, John, none of those things have happened. And that's to do with if they were going to happen, they were going to happen with the headlines. They were not going to happen when it actually plays out. It's very, very hard for me to see big new second-order effects now, the consumer pulling back hard. And without that, you do not get a lasting, like a recession, a lasting hit to U.S. growth.
Are we measuring the economy correctly? And I ask that because there are pockets that are clearly suffering. And you're seeing that in numbers like from Southwest, where consumers who don't have as much money aren't able to travel as much. But then you have this industrial revolution, this renaissance, this huge investment in AI technology that's generating efficiency and profitability at the biggest and the most powerful companies and individuals. Is this showing up in the data, or is this just changing the way we understand our economy?
I think it's the latter. I think we are measuring it correctly. There's no reason to believe that we've suddenly changed. The fact of the matter is what you said. The United States is two different economies. One is the old economy. We all grew up believing housing is a business cycle, for example, and housing is struggling with mortgage rates staying where they are. The durable goods sector, you mentioned airlines, they are struggling. Doesn't matter. You have the large tech side and the AI dividends starting to kick in. And I think that matters far more at an index level, at an economy-wide level. The fact that the hyperscalers just never pull back on spending. You might have worried as an importer into the United States about Mexico, Canada, whether I can make my business work or not. Who cares when Google is spending another $85 billion at a macro level?
Well, at the same time, back during the pandemic, it was sort of the revenge of the fiscal world. That was something that John said every morning as we walked in. And it was sort of the reality of trying to get toilet paper, although he had stacked up. I am just wondering whether we're going to end up with revenge of the physical world once more. We're talking about investment in the cloud, in all of this sort of technology that's for companies, the way we think, the way we do work in white-collar businesses. What about the goods and services that have to go over on ships?
I don't think there's going to be a revenge of the physical world. I almost think it's the other way around, meaning that right now we are all focused on LLMs. You put in text and you get out a bunch of information. That is the AI models, and that we think will hit services jobs. The fact of the matter is, I think we are 3, 4, 5 years away from the same thing happening, where you put in a bunch of text and you have a robot doing subtasks. I'm not kidding. This is not sci-fi. This is. I feel the way I did about NVIDIA 5 years ago. None of us thought it would get as big as it is. But the fact of the matter is, that Moore's law The fact that things are twice as cheap, every 18 months they're twice as powerful, does work in the semiconductor world, doesn't work in the physical world. Fusing AI and robotics is powerful, and I almost worry that you're going to have more of the profits continue to go to capital. We always grow up believing, plumbers, you'll always need plumbers. Well, you might not 5, 7, 8 years from now.
What you're saying could ultimately mean the market is okay, but the employment market gets a whole lot worse.
It does, and
are there limits to that?
The limits are put in by society. At some point, there are 70 million knowledge workers in the United States. I've had a person I consider the single best investor of all time make the argument to me that he's looked at this upwards, downwards 5 years from Sunday, and he's telling me that 10 million of these workers will not be needed in 5 to 7 years. He's not saying they won't have jobs. The economic activity that they do now, the value add will be done by machines. We see it in big tech, right? 40% of coding. You realize Microsoft's let go of 20,000 people. They have money coming out of their ears. There's a reason why this is happening. Eventually, society pushes back. It's happened in every technological revolution. But the difference now, John, is that in the past, when you had this, right, we were okay with debtors' prisons. We were okay with child labor. 100 years ago, the transition, we didn't make noise. This time, it'll make a lot of noise.
I'll share with you what concerns me, and I'll be open and personal about it. For children of Thatcher and Reagan, I'm highly concerned that if you concentrate capital and wealth in the hands of just a few, that the political movement, the corrective course of action on behalf of the people will be for the state to get a whole lot bigger, to go forward with higher taxes, universal basic income. And for people like me who don't really believe ideologically in that view of the world, that scares the living daylights out of me.
It should, but that is a very real risk. Now, until we get there, you're going to have corporate earnings flatten, for years to come. You're going to have operating margin leverage. And then the other side of it will be society pushing back. It's happened before. 6 of the 7 big oil majors came out of one company, Standard Oil, remember? So this is not every 15, 20, 50 years, if you have a big technology change, where all of the advantages go to capital, which is what is going to happen, I think eventually society will push back. But until it happens, it's actually a very nice ride.
But building on John's point, should we just expect higher deficits then?
No, I think the OBBA and the tariffs from revenues, the total deficit from that is not higher than if just the Trump tax cuts that were expiring had been extended. And we all thought they would be extended, if nothing else, right? The problem, the reason why the long bond in the United States refuses to come below 5% is not because the OBBA is more profligate, it's because it locks in. It makes it clear that we are not going to go away from 6.5% to 7% deficits, which is where we were this year, last year, for at least 10 more years. You mentioned Rachel Reeves and the conversation from 3 weeks ago. The significant part was not that she got emotional in person. The significant part for me was Labour has a big parliamentary majority and cannot pass a simple change, a small change to the welfare bill. That was the significance of it. There's no political will.
Ajay, appreciate your time. Enjoy the ride in the market right now, seems to be the message, and we'll catch up in 5 years' time.
Cheers.
With us around the table, Libby Cantrill of PIMCO. Libby, good morning.
Good morning.
August 1st. Are we going to wrap this up, or is that the new July 9th?
Look, I think what we've been telling our clients is that we are going to be living with trade policy and tariff policy uncertainty for the duration of this administration. So maybe we get a little bit more clarity. I would agree that 15% is the new 10%, 10% is the new 0%. The best that a country can hope for, those with trade surpluses, is going to be 10%, and then everything else is going to be higher. Japan got, I think, arguably a pretty good deal here. But again, if we just take a step back and go back to December, right after the election, and we were just saying we're going to be sitting here and talking about how 15% seems pretty benign on one of our closest allies and trading partners, I don't think anybody would believe it. So I think that the Overton window, if you will, has really been expanded here, kind of shattered in terms of what is acceptable in the markets and in Washington. And again, I think from an economic and markets perspective, we do think this will start having a bite at some point, even though maybe markets are just, willfully ignoring the reality here.
Or are the markets numb? Has Trump basically conditioned them to accept 15% because they're not as the sky-high April 2nd tariffs originally this administration came out with?
Yeah, I think what we have been talking to our clients, the sort of like the taco man versus tariff man, this idea of Trump always chickening out. And if you actually look at the tariff level right now, it would not suggest that he is chickening out. Yet, yes, he has softened his most extreme stance. So will the effective average tariff rate go up to 30%? Not likely, but where we think it probably will land is between 15 and 20%. 15 and 20% tariff. I mean, that's not insignificant. So yes, I do think that in some ways, again, this idea of the Overton window, sort of what's possible in Washington, he's expanded that so much that the market is somewhat desensitized. But we do think this will start having actually real economic effects at some point.
When it comes to these negotiations, I was really struck by the Japanese one because of that $550 billion fund. And I'm still kind of confused about exactly what it is, because the Prime Minister of Japan is talking about that these are basically loan guarantees, and Howard Lutnick, the Commerce Secretary, is saying it's much, much more than that. Almost sounds like a bit of a slush fund. Do you understand what the administration is looking for when it comes to trading partners?
Yeah, I think we are like everybody else is waiting for the details. I think a couple of things on this. One is that for another country to be funding our industrial policy, that could actually have some implications. So I think there's one of just sort of, is this sort of politically realistic that you're actually relying on another country to actually make investments in things that are important from a national security or from an economic perspective for the country. The other, which is a little bit technical and a little bit wonky, but I think also important, is if the objective for the administration is to reduce the trade deficit, you can't reduce the trade deficit with a country and increase the capital account. Those things are supposed to be offset. So, I think that you're trying to have kind of both ways here. So we'll sort of see what the details are. I think our suggestion to our clients is just to focus on what we do know, though, which is the 15% tariffs. And again, that's an increase from the 3% that we had in January.
You have the joy and the opportunity of going around the world and explaining this to everybody. And I'm curious how different the reaction is for people not in the U.S. versus the United States, and how they plan to sort of operate around that.
Yeah, I was just saying before the segment that I was in Canada yesterday meeting with some of our large institutional clients. I've been all over the world. We have the benefit of having long-standing relationships with clients, again, outside of the U.S. and inside the U.S. And the perspective is different. I think that some ways there's sort of asymmetry around the information. So I think there's some assumptions that are made that maybe are not necessarily right for our foreign clients. But I think more importantly, our clients were already over-indexed to sort of U.S. equities, to U.S. dollar-based assets coming into this year, right? The sort of the narrative of American exceptionalism, the expectation for just blockbuster growth in the U.S. and sort of languishing growth elsewhere come in January. That obviously has changed. Those expectations have changed. So our clients, in some ways, were already reevaluating some of their dollar-based asset allocation, and I think this probably has accelerated that. Certainly, the tariffs, I think, again, maybe they're impervious to that, maybe a little bit more desensitized. Some of the knocks on the Fed, some of the questions about the strength of the institutions, sort of the political, functionality of Washington. I think those all are still questions front in terms of in their minds.
Sam Zeef of JP Morgan Private Bank was on earlier, and he said initially people just work in the derivatives market to hedge their dollar exposure, but the actual reallocation happens over time. Is that something that you're seeing too, that there's a lot of reallocation away from dollar-denominated assets in the pipeline that hasn't fully come to the fore yet?
Yeah, I would say with our clients, we are seeing exactly that. We're seeing them sort of being taken out in the FX market, hedging their dollar-based exposure. Broadly speaking, there was some discussion around the tax bill. There was a Section 899, the revenge tax, which was definitely, I think, would have had some significant implications on actual asset allocation. I think now they are maybe sort of taking a step back and not necessarily divesting from the U.S., but I think sort of maybe hitting a little bit more of the pause button in terms of new allocations to this. But of course, it's different for every client, so I don't want to sort of generalize, but I do think that there is more of just a reevaluation of some of their dollar-based assets.
Libby, it's good to see you. As always. Thanks for being here. Libby Cantrill there of PIMCO. Dan Ives of Wedbush is the biggest Tesla bull on the street with a price target of 500 and an outperform rating. Dan joins us now for more. Dan, good morning.
Great to be here.
Revenue down 12%, vehicles delivered down, average selling price down, and yet you're at $500. Tell me why.
Yeah, I mean, look, the quarter itself, nothing to write home about. But I mean, our view, it's about autonomous robotics. AI is the future for Tesla. So to me, yeah, it's a rough few quarters ahead. But I believe autonomous, we are in the beginning. What's going to be $1 trillion valuation alone for Tesla. So that's why I don't get so concerned when we talk about deliveries, which actually were kind of in line. When we look at what's going to happen in the second half. The story here, when it comes to physical AI, two best ones out there, it's going to be Tesla and NVIDIA.
Moving from a pre-autonomy to a post-autonomy world, did he do enough on the call last night to convince investors that it's going to be smooth sailing?
Look, I mean, obviously the call, definitely some could have criticism in terms of promising so much. Look, my view is if 20 to 30% of what he promised you see in the next year, this is a stock that's up 70, 80% from here. So that's why when I look at Tesla, I don't focus, and we've talked about it so much in the show over the years, I don't focus near-term deliveries, what that means in terms of, EV tax credits. This is an autonomous robotic story. And I think, look, the AI revolution, as we saw from Alphabet, I mean, we are just in the early days of this playing out.
Maybe I'm Chicken Little, but I was looking at this press conference. I was reading this and I was thinking, this is a disaster. I mean, essentially, this was a dream stock, and suddenly they're talking about tax credits and things of that nature. They used to talk about an affordable vehicle. Now they're talking about a stripped-down Model Y that doesn't sound that sexy at all, and they're going to expedite production of other vehicles and put that on hold. What would it take for you to get bearish?
Yeah. Look, I mean, you bring up great points. And that will be the bearish points. And when it comes to the affordable next vehicle, is that just going to be a stripped-down version? Look, Lisa, my view is that it comes down to robo-taxi. If you're in 25 cities in the next year and you actually start to get volume production of Optimus when it comes to robotics, I think 90% of the future value is going to be in the AI story, not on the actual deliveries in terms of cars out there. You have 10 million vehicles in terms of Teslas out there. It's all about the data. And I believe the big thing is going to be the shareholder meeting where they'll have a significant investment in XAI. And I think that's where you get more of a wartime CEO in Musk. And I think that's really going to be the difference.
Were you satisfied by his answers about XAI, about the investments there, the crossover with Tesla? Because there was a lot of ambiguity. Yeah. And he was asked that directly, and he wasn't able to explain that connection and how it really does rebound over, other than some people who are in this industry don't really want to work at a car company. I want to offer them an opportunity to.
Yeah, I wouldn't say that conference call is not, you wouldn't put him in the Neary Hall of Fame, that conference call, okay? But again, we know with Musk, it's never going to be, it's not going to be Microsoft-like. But my view is, and we've talked about it, the board, they need to get him 25% voting. I think that's key. That starts what's going to be a significant investment in XAI. But we've said also, are there guardrails there that they need to put on? You've seen them become less political since the July 4th third party, too. So I think, look, you want to see him less focused on that, more focused on being CEO, because it comes down to the biggest asset for Tesla is Musk.
The press secretary yesterday was asked, does the president support federal agencies contracting with Elon Musk's AI company? Her answer, I don't think so. No. Can he do this without contracts?
Look, I think, but then it comes down, look at Grok. I mean, when it comes to Grok and a huge part of the DoD deal, look, the reality is that Trump administration could say what they're going to say, but they need Musk. Of course, they need Jensen. I mean, they're going to need leaders when it comes to, of what this AI revolution. I think, look, that's the reality. And I do think at one point you'll start to see them, I wouldn't say necessarily become friends again, but sort of mend fences given what Musk needs to do going forward.
Elon Musk, Sam Altman were not called out yesterday when the president was giving shout-outs at this AI summit. Is Jensen Huang the new first buddy?
Look, he's at the cool kids table. I mean, right now, if you look where Jensen is, he is the first buddy for Trump. Because
he's almost running policy, Dan.
Look, and the reality is there's one chip in the world fueling the AI revolution. And that's why when it comes to the Middle East trip, who's to the right of him? Jensen. When it comes to anything, when it comes to China negotiation, the biggest poker chip that you have is NVIDIA. I mean, when it comes to, so first buddy is wearing a black leather jacket, his name's Jensen.
Final word, Alphabet. What did you think of the numbers?
I thought this was as bullish as you could see in terms of the actual numbers from search, from YouTube. And this is no longer an Alphabet in the corners, like crying. This is one coming out being like, we're on the offense.
Do you think they can make the transition from that ad model that's dominated the last several decades in Silicon Valley? We can make the transition away from that?
I think it's going to be a renaissance for Alphabet. I believe from a large cap perspective, it's one of the best risk rewards out there. That's why it's a table pounder. We went 225 in the price target. And look, haters hate on this, and I get it. But the bears in hibernation mode, there was nothing on that call that they're going to grasp onto. And I want to see them increase CapEx. It's an arms race right now in AI. You want to see them in the left lane.
The good news is the market's willing to support them, Bramo, that the stock is up off the back of this CapEx boost and it's not down, because then they'd have very different problems.
Well, initially it was down, and that was interesting because people had the knee-jerk reaction of stop spending so much before you can give us a sense of how you're going to monetize it. But as he spoke and he talked about customer demand to change, right now I am ChatGPTing, is Google search in its decline, and I will let you know what it says.
But I'd also say the bears, when they're in hibernation mode in the caves, they can find AI in the spreadsheets. And that's part of, I think, how they've missed so much of this AI revolution. Look, get the popcorn out. This is just a precursor of what's going to be a bullish tech earning. Microsoft, Meta, Palantir, and others.
Dan Ives of Wedbush. Dan, appreciate
Great
it.
to be here.
With us around the table, Nela Richardson of ADP. Nela, good morning.
It's great to be here with you.
It's good to see you. Let's talk about this jobs data. We've heard a lot from a lot of people who say this labour market is no longer a reason to be hawkish. Is it becoming a reason to be dovish?
I think you can't say that this labour market's not in transition if you look at the last 3 months of hiring. They're slowing. It's clear. And so whether hawkish or dovish, the labor market is an issue on the table to consider. And I think when we look at next week, which will be jobs week, we'll see a continuation of a slowing trend. And I'd like to mark that trend with something that you can see clearly in the ADP data. The slowdown isn't coming from goods. It's coming from services. And that is the turnaround in the labor market. It has been that services have held the water for the labor market. It's really the goods sector that's suffered. And with tariffs in play, still, you would think it would be the goods sector that is bringing down the momentum. It's not. It's services, which points to a whole different case study on what's really going on in the U.S. economy.
So talk us through what that case study is in terms of, are we just seeing the cycle shift from goods to services, but goods hiring will pick up significantly, or does this speak to a broader type of trend?
You know, there's so many megatrends right now, and I like to look at the first 6 months of 2025 and compare it to the first 6 months of 2019 before the pandemic. This was actually inspired by something Jonathan said about getting a pay raise. Because if you look, I thought it was a great question. I wasn't satisfied with my answer, so I went to the data, and it turns out that there hasn't been an increase in new hire average pay in over a year. Wow. $18 it's been. And that's because the supply and demand dynamics have held firm. It's a really balanced labor market. I think it breaks because we're seeing lower supply. The labor force participation rate now is lower than it was 6 years ago. There are fewer people working and looking for work, and that's what's going to keep pay a little bit higher or a little bit more stable for new hires than it was 6 years ago.
So this raises a really good, interesting question. Even if we get numbers that look pretty good on the jobless front, not that many jobless claims, on the job creation front, more than some people would expect, is there anything about this labor market that's inflationary with wages increasing?
Well, this is a very deep labor market. We talk about whether it's solid. I think of it as deep. Still waters run deep. And what you're seeing is that, yes, if you look at job stayers and job switchers, which we look at all the time at ADP, pay growth is elevated. But when you look at those new hires, they're pretty stagnant. And I also look at the job openings by the U.S. government, which shows 500,000 more jobs now than there were 6 years ago. But the hiring rate, the rate at which employers are hiring is lower, 3.4 in May compared to May 2019, 3.8. There is less urgency to fill those positions. And that's what's leading to this no hire, no fire stasis in the jobs market. I think it breaks because of labor supply issues, not necessarily labor demand issues.
Governor Waller was sitting in your seat last week, and it seemed to really weigh on him, the unemployment rate on recent college grads, 7%. What's going on? Why are they not able to get a job?
Well, I think it bends back to the data we just saw. Continuing claims. It's harder to get a job in this labor market where supply and demand are in balance. And for young people coming out into the market, this is not their older brothers or sisters' labor market. In 2022, they were snatched right up. They have that expectation. Their older sister told them that they were snatched right up, and that was the expectation. It's not that labor market anymore. It's a labor market that requires patience and networking. It's Gen Z. It's going to take a little bit longer. And where these college grads are coming out is what exactly is slowing. Professional businesses, services are slowing down. Finance is slowing down. If they were coming out in construction, I think they would see that kind of snatch up in the labor market, but they're not seeing it now.
Nela, it's great to see you. Thanks for breaking it down. Appreciate it. Nela Richardson there of ADP.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.